Are we seeing much margin pressure so far because of labor, as far as you can tell from the earnings season?
You know what I would say this earnings season, I actually think we continue to see some resiliency within earnings, and there's actually potentially a path to seeing positive earnings growth, which has not been the case for the past 3 quarters. I would say, though, in terms of the market reaction and what we're seeing around earnings, it's much more of a macro picture. Rates are still in the driver's seat, but the other part that's in the driver's seat is tech. And so you've seen some pretty binary reactions in terms of not only the earnings, but also forward guidance in terms of their expectations. And the market is heavily reacting to that. And if you look at volatility around earnings, we are seeing a wider spread in terms of some of those movements than we have seen in prior earnings seasons.
So, Chris, when I hear tech, I think about Magnificent Seven, right? Isn't that what we call it these days?
That's what we call it.
Are they holding up? Because we saw a little bit of shakiness in some of those Magnificent Seven this week.
So the answer to that is the stocks aren't holding up that well. What it is some good, some bad. The underlying fundamentals, fine, right? The reaction function, not so fine in some cases. That's part of guidance. But here's a funny thing. If you're a company, your stock's up 100%, you're looking forward, you might want to manage expectations, bring things down, so your stock goes down 5%, 10%. You're already up 100. You want to lower those expectations for next year. You want to set things up for next year. And so it's not quite clear to me if it's a management of expectations or they're really saying something that we're not seeing, because the results for some of the companies are actually quite good.
Well, what are the patterns that you're seeing so far, Chris, in this earnings season?
So surprisingly, what we're seeing is margins are holding up well. We're seeing top line beats, but the issue is, or the rub is, guidance hasn't been as good as it has been in the past. And companies are being taken down a notch due to that. Whether that's because they're seeing something that we're not seeing, they're being more conservative, they're managing expectations, unclear, but the underlying fundamentals in the here and the now are fine. The last thing I'd say is that when we look at earnings and we go through transcripts, and we look at what the C-suite is saying, we are seeing things, the tone change get a little bit darker around the consumer, which isn't a surprise, but it's something we're watching very closely.
Which is something you mentioned earlier, Kristen.
Exactly. I think the other thing, too, is when you look at, going back to this conversation around tech and the Magnificent Seven, those stocks are priced for perfection, right? So, of course, there's going to be a little bit of an overreaction to, and giving back some of the gains that we've experienced year to date, because as we all know, the market has been so concentrated in those 7 stocks. So I think what is interesting is, as we're kind of, if we've seen the bottoming of corporate earnings, and now we're kind of pivoting into modest growth. I do think 2024, Chris, I'm not sure about your view on this, but I think 2024, the outlook is a little bit too rosy, especially if we're in higher for longer rates.
I think that's right.
But within that, there are opportunities in some of these sectors, and some of these profitable.
Not price for perfection.
Yeah.
Let's talk about defensive stocks. Let's talk about small and mid caps, because those are not, I don't think, priced to perfection.
No, if you look at small and mid caps, I think the interesting thing is, of course, if you're in a higher interest rate environment, this idea that are their balance sheets clean? Are they exposed to floating rate debt? But within, let's take like mid caps. Within mid caps, you have parts of that market that actually are profitable. Let's take like industrials, right? So if we're looking at industrials, you're looking at infrastructure, defense. Industrials are only like 10% of large cap, but like 20% of mid cap. Are there opportunities within there to have exposure that makes sense from a valuation perspective, as well as a go forward perspective? Absolutely.
So, Chris, from your point of view, are those bargains, or is there a reason they're so cheap?
So I think Kristen's been reading a lot of our research because what we've been saying is mid-cap growth is your best risk reward. You have companies that are, an index companies that are trading at mid-teens. They've been derated on a fundamental basis. They've been derated on a price basis, but fundamentals are beginning to turn. They're not crowded. There could be some M&A as we move forward in time, and they're companies that don't really rely on the stock market, or excuse me, the economy to really power through. They can power through by themselves.
But if I understand, selectively, some active management, right?
Stock
I would
picking
say so.
is key.
Absolutely.